Welcome back to the Deep Dive. This is where we give you the most important strategic insights pulled straight from the research we do for the WeWire Stay Wired Weekly Recap. I'm John.
And I'm Wendy. We're both staff here at WeWire. And yeah, our job today is to kind of distill all this info into something genuinely useful. And today, we're really focusing on this global, battle for currency confidence. The winners might not be who you think.
Yeah, we absolutely have to kick off with this pretty staggering figure that really framed our whole discussion this week. It just jumps off the page. An IMF analysis looked at $2 trillion in global crypto flows.
$2 trillion, yeah.
And it found that Africa and the Middle East alone saw over $200 billion in stablecoin activity just in 2024.
Wow, that's not small change, is it? That's a really significant financial flow. And, if you dig into that number a bit more, you see that Tether's USDT and Circle's USDC, these are the big dollar-backed stablecoins they make up, but like 57% and 43% of that volume in the region. Roughly.
So basically, almost all of it is dollar-pegged.
Pretty much.
Yeah.
Which really brings us to the core question, doesn't it? You've got central banks hiking rates like mad, trying to control inflation. You've got local currencies losing value, sometimes daily. So are these dollar-backed digital tokens actually winning people's trust? Let's unpack this.
Okay, so to really get why people are making this $200 billion move, we first need to understand just how bad the inflation crisis is in many places. I mean, globally, the IMF said inflation shot up to about 8.7% back in 2022.
Yeah, that was the peak.
And it's forecast to ease a bit, maybe towards 5% this year. But, averages can hide a lot.
Oh, absolutely. They really can. I mean, while some countries might be breathing a sigh of relief seeing single digits again, the reality on the ground in these high inflation economies is, it's devastating. This isn't just numbers on a chart.
No.
It's families watching their life savings just evaporate. Think about Nigeria. Their currency lost something like 40% of its value last year alone.
40%, wow.
Or Zimbabwe, still wrestling with triple-digit inflation. I mean, can you imagine? Your money basically becomes useless almost overnight.
And the central banks, they react how you'd expect, right?
Yeah.
Aggressive rate hikes, pushing rates up to levels we haven't seen in years, desperate to anchor prices somehow.
Right.
But even with all that effort, that massive monetary policy push, double-digit inflation just sticks around in so many countries.
Right.
And that's the real problem, isn't it? When the institution that's supposed to guarantee your currency's stability, the central bank just can't deliver. Well, trust in the local money just vanishes.
Exactly. It's like the mechanism itself is broken. Sometimes these rate hikes just don't work if the root cause is, say, structural, like relying heavily on imports you have to pay for in dollars or massive government deficits.
Right.
So people look at it and realize, their central bank maybe doesn't have the tools or maybe lacks the political will to actually defend the currency. And that makes fleeing to anything stable seem like a pretty rational choice.
Which brings us neatly to stablecoins. Because stability, that's exactly what they promise. We're talking about crypto tokens pegged one-to-one, usually to the US dollar. And for listeners who follow this space, the key thing isn't just what they are. Yeah. It's how they're acting as a better way to store value compared to the local currency that's, melting.
Precisely. Unlike your local fiat money, where the value is basically backed by the government's promise, the reliability of a big stablecoin like USDT or USDC depends on their reserves. Actual cash, UST bills, other short-term stuff they hold.
So real assets supposedly backing the peg.
That's the idea. And that's why, both big institutions and just regular folks in these volatile markets are increasingly trusting that dollar peg, backed by audited assets, more than they trust the promises of their own central bank. It makes sense, in a way.
And this shift, this is exactly what that data from Africa and the Middle East shows so clearly. What was that $200 billion in activity this year? But look at how deep it goes into the economy. Stablecoin transaction volume in Africa last year was equal to about 6.7% of the entire continent's GDP.
6.7%, that's huge.
That's not just some niche tech thing. That's real economic integration. I mean, that's comparable to major sectors in some of these places.
And here's where it gets really interesting, I think. Our sources show that the vast majority of these flows, something like 86%, are actually cross-border.
86%.
Yeah. No. Which pretty much confirms what people suspected. Stablecoins are being used heavily for remittances, for international trade, and probably for getting capital out of countries where inflation is rampant. The old banking system, often too slow, too expensive, or just can't handle it, especially when getting hold of actual foreign currency is tough.
Right, the FX scarcity problem.
Exactly. So stablecoins become the workaround. And if we look closer, region by region, Chainalysis data confirms stablecoins are just dominating crypto activity now. Take sub-Saharan Africa. Mid-2023 figures showed stablecoins were about 43% of all crypto transaction value.
43%. More than Bitcoin.
Way more than Bitcoin in terms of transaction value share there. So this isn't people chasing speculative gains on BTC. It's a flight to a sort of decentralized dollar. It's pure utility.
Let's drill down into Nigeria then.
Yeah.
Africa's biggest crypto market. Over 70% of crypto trades there involve stablecoins. 70%.
It's incredible.
That's people actively, deliberately trying to protect themselves, right?
Yeah.
Small business owners, people earning salaries, trying to shield their wealth from the naira's devaluation. They're choosing the digital dollar because it actually holds its value, unlike their cash.
Yeah, it effectively becomes this crucial proxy for the dollar. It lets businesses keep going, maybe price things more predictably. When getting actual FX from the banks is difficult or super expensive, it's become like an essential tool.
And you can literally map the spikes in usage to currency crises. The correlation is just undeniable. We saw clear examples last year, 2023. Ethiopia's currency, the birr, lost about 30% around the middle of the year. And guess what? Retail stablecoin transfers in Ethiopia jumped roughly 180% year over year during that same period.
Wow, 180%.
Yeah. And Zambia, similar story. Their currency struggled. Stablecoin use jumped around 140%. It's not a coincidence.
Yeah.
It's people reacting directly to their money failing them.
And you see it happening at every level. We hear about Ghanaian importers using stablecoins to pay suppliers abroad because they can't get dollars through official channels easily. Small traders, say in Kenya or Sudan, using them for sending money home or getting paid almost instantly.
Skipping the old slow banking system entirely.
Completely. Especially when those systems have proven unreliable or too costly.
Okay, but this raises a big question, doesn't it? If people are basically fleeing to the dollar via these stablecoins, aren't we just seeing a kind of backdoor dollarization happening in these economies? But without any official oversight, isn't that exactly what central banks are worried about?
That is absolutely the core dilemma for regulators, yeah. On one hand, stablecoins are solving a very real, immediate problem for users, the need for stability. But on the other hand, yes, they absolutely fragment the central bank's control over money.
Right.
And they introduce potential systemic risks if those reserves backing the coins aren't as solid or as liquid as claimed. That's why audits and transparency are so critical. Their whole credibility relies on it.
So what are central banks doing? Just watching this happen?
No, they're definitely not ignoring it. They're scrambling to develop their own defenses, really. Many are fast-tracking plans for central bank digital currencies, CBDCs. The idea is to offer their own state-backed digital currency that's stable, efficient, and hopefully restores some public trust in the local monetary system. It's a direct response.
Okay, so this whole dramatic story, the distrust in local currency, the massive shift to digital dollars in these regions, it's all happening against this wider backdrop of global economic uncertainty, right? Which is what we track in the rest of the statewide recap. It's important to connect those dots.
Absolutely, because this flight to stability isn't just happening with stable coins in specific regions. You see echoes of it globally with traditional safe haven assets, too. I mean, look at the FX markets we track. That deep instability feeds the local distrust.
Yeah.
Like the Ghanaian cedi you mentioned earlier, it's continued to weaken significantly this year, one of the worst performers against the dollar in the region. That kind of trend directly fuels demand for any kind of dollar proxy, digital or otherwise.
And contrast that local currency pain with what's happening with, say, gold globally. Gold prices have been strong, recently near $3,748. Why? Well, classic safe haven appeal. Geopolitical worries, nagging global inflation fears. So you have global investors buying gold to escape general risk and local consumers buying digital dollars to escape specific currency risk. It's kind of the same impulse, isn't it? A failure of trust, just playing out differently.
That's a great way to put it. And we also have to watch commodities because they're huge drivers of inflation and FX stress in many developing economies. Brent crude, for example, rallied near $69.55 recently.
Yeah.
When oil prices spike, it just makes those local foreign currency shortages even worse. Businesses suddenly need even more dollars to pay for essential imports, pushing them towards whatever source they can find physical dollars or, increasingly, digital ones. So commodity swings aren't just side notes. They actually accelerate this stablecoin trend.
Okay, so summing that part up, stablecoin demand is booming, Some projections see the market hitting maybe $2 trillion by 2028.
Yeah, potentially huge growth.
And this demand is fundamentally driven by the lack of price stability in local fiat money, often made worse by global shocks like oil price hikes.
Exactly. So to kind of wrap this up, stablecoins, they offer clear advantages right now, especially for cross-border payments. They're cheaper, faster, and they offer that fixed peg to the dollar, which is incredibly appealing when your own currency is sinking.
Irresistible, almost.
Pretty much. But, and it's a big but, we have to keep stressing the risk. The whole system's credibility hangs on the quality and transparency of those reserves. Are they really there? Are they liquid? That's the ongoing regulatory headache.
So what's the takeaway here? What does this all mean for you listening? Well, it seems pretty clear that trust is the core issue. Inflation eats away at confidence in local money, in the local central bank. And that trust is shifting.
It's flowing towards the most credible alternative available. Right now, in many places, that seems to be the dollar digitized and running on a blockchain. It's a massive shift, really redefining what people consider money in major emerging markets.
Which leaves us with the big question for the future, doesn't it? What happens next? Can the central banks actually get inflation under control and restore faith in their own fiat currencies?
Yeah.
Makes them viable again?
Uh.
Or will stablecoins, assuming they can maintain that crucial backing and transparency, keep growing and solidify their role? Which outcome do you think is more likely over, say, the next 5 years? Something to think about.
Stay Wired Weekly Recap was produced by WeWire,
a B2B company, bridging the banking gap between emerging markets and the world.
Tune in same time next week for the Stay Wired Weekly Recap.